Inflation continues to hover above an annual rate of 8%, with prices for gasoline, natural gas, food, and used vehicles rising the most. The last time inflation was this high, Ronald Reagan was only a year into his first term. After a decade of global oil supply shocks, easy monetary policy, and expanding government borrowing, the convertibility of the dollar into gold had recently been suspended, and this had the immediate effect of devaluing the greenback. There are key differences between then and now, but there are also a few obvious parallels. Today, we're facing our own global supply chain disruptions, for everything from food to energy, largely as a result of the war in Eastern Europe and ongoing COVID lockdowns. A shortage of semiconductor chips has slowed the manufacture of new automobiles, appliances, data centers, and more. The truth is, officials are much more comfortable with deficits today than they were in the 1970s, and that's all thanks to modern monetary theory, or MMT. Advocates of MMT believe that deficit spending is perfectly fine since the government can just issue more of its own currency to pay for it all. For the first time ever, the federal government now owes over $30 trillion, or nearly 130% of the US economy. And thus the cycle continues. So what can investors do? Again, history is a valuable guide. The best asset to own in the 1970s was gold, which went from $35 an ounce at the beginning of the decade to as high as $850 by 1980. Investors sought a hard asset that could go toe-to-toe with inflation and hold its value over time. The yellow metal fit the bill. Unlike fiat currency, which policymakers can create out of thin air, gold requires incredible amounts of time, energy, and money to produce. This helps keep its supply in check. But does the thesis hold up? Well, consider this. So far this century, through the end of April 2022, gold has outperformed the S&P 500 by a factor of 3. Gold has been the better asset, delivering a positive return in the first 4 months of the year. Not bad for a barbarous relic. Some market watchers may wonder why gold hasn't climbed even higher. Indeed, when inflation surpassed 8% in March 2022, the metal's price was not quite able to beat its record high of $2,073 an ounce set in August 2020. To address why that is, we would probably need to make a whole separate video on gold price manipulation and suppression. There's speculation that the recent popularity of Bitcoin and other digital assets has siphoned off investors' money that would otherwise have gone to gold. As Bitcoin fans ourselves, we're not so sure. It's universally respected and traded. Dozens of central banks around the globe continue to hold billions of dollars worth of gold in their reserves. Even if physical gold is not hitting new highs, its resilience in the face of runaway inflation tells us what the market seems to favor right now are hard assets that have intrinsic value. It's little wonder, then, that the prices for nearly every commodity, from metals to energy to agriculture, are going parabolic in many cases. We saw the same thing happen in the 1970s. The S&P GSCI, which tracks a basket of commodities, surged sevenfold during the decade, while the S&P 500 remained mostly flat. With commodity prices doing so well right now, we believe energy producers and metal miners look attractive by extension. Inflation may not be as transitory as the Fed maintained early on, but at some point out, prices will stabilize. Until then, it's important for investors not to make rash decisions and panic sell at a loss. If nothing else, it may be prudent simply to hold your positions for a longer duration than you were planning. This isn't the first spate of inflation we've seen, and it likely won't be the last. To read more about this and for up-to-date information about precious metals, subscribe to free research by visiting usfunds.com. Happy investing!